Welcome, traders, to the inaugural Rolling Trades podcast with RJO Futures. I'm senior market strategist John Caruso. We are going to touch on a few different subjects here today. We're going to spotlight a few key markets that are moving around later on in this podcast. But first, we're going to start where I always like to start in my investment process, and that's with the macro research. We always want to know where we're at within the investing cycle based on growth, inflation, the labor market, earnings, and of course the Fed and their policy. So first, we're going to start with growth. We did see contraction in Q1, down 0.2% for the U.S. economy. That was largely better than expected, though. We did see the Atlanta Fed GDP nowcast that was forecasting back in Q1 of a contraction of 2.7%. The contraction was largely led by the rush of imports, the imports-exports balance in the GDP equation, as we did see a lot of companies try to rush those orders and get those in ahead of the April 2nd announcement of tariffs. Coming into Q2, we are expecting greater than 2% growth. That's the early estimates right now. We are going to largely see some macro data pertaining to growth come in over the next 30 days that we have to take with a grain of salt, because you got to remember back in April, we did have the tariffs in place and a lot of that data was affected. Now, since we've seen the rollback in tariffs this past weekend during the U.S.-China trade summit, we've got to take that growth data, that slowing growth data that's likely to come in, with a grain of salt. So it does look like the U.S. economy will evade a recession here. Obviously, the definition of recession is multiple quarters of contraction in the economy, and we are actually expecting some robust growth for Q2. Taking a look at inflation, we are seeing a sequential decline in inflation. We saw headline CPI that came out at 2.3% just recently on Monday. That has come all the way in from 3% that was reported back in February. So we do have inflation trending in the correct direction. A lot of that moderation in inflation is largely due to energy prices. We have seen crude oil prices contract about 18% year over year, and we are down 11% in crude on a year-to-date basis. I do actually believe that could be reversing a little bit here. We're going to touch on that later on today. But all in all, inflation trending back towards the Fed's 2% target. I do actually happen to believe that this might be one of the last sequential declines in inflation, at least over the intermediate term. Taking a look at Q1 earnings growth, earnings largely surprising to the upside. We have seen for the S&P 500 13.4% earnings growth to date. We are winding down in the earnings season right now, so that is the second consecutive quarter of double-digit growth for S&P 500 earnings. A lot of that was largely led by mega cap tech. We did see them report revenue in increases of 28% on a year-over-year basis, as opposed to 9% for the rest of the S&P 500. As I mentioned, we do have NVIDIA still left to report. That is on May 28th, so the market's going to be looking forward to that. As far as the labor market's concerned, labor continues to chug along. The recent NFP report that we saw last Friday did show 177,000 growth for the month of April. So no problems in labor right now. We just actually did hear from Microsoft. They are planning on laying off approximately 3% of their labor force in coming months. So we're going to kind of keep an eye on that and whether or not that is a developing trend throughout the tech space. As far as the Fed is concerned, they are largely data dependent right now. They are still steering the market towards 2, maybe 3 interest rate cuts in the back half of the year. We did see the market recently price out July and push it back out to September. Current Fed policy rate stands at 4.25% to 4.5%. One of the key instruments that I use to dictate future Fed policy moves is I follow that two-year yield pretty closely. We have seen the 2-year yield bounce from 3.60% back in April to recently back above 4% here today. So what the 2-year yield is telling us is they are starting to price out interest rate cuts as opposed to pricing in more future cuts. So we're going to keep an eye on that. 4% right now, that is forecasting that the Fed is only going to move twice this year. But of course, that we have seen some volatility in that instrument. So There's nothing that says that we can't see that gravitate back towards 360 from here. So now we're going to jump into a few charts here. Of course, we're going to look at the S&P 500, gold, silver, copper, and we're going to conclude with oil. So let's get a chart of the S&P 500 up there. When I take a look at this chart here, I'm staring at a bullish trend, positive momentum. Of course, we did see the gap and go on Sunday night coming out of the trade summit between the U.S. and China in Geneva. I think what we're seeing here today is largely hedge fund capitulation. I still think there were a lot of bears in the market, and with the rollback in tariffs that a lot of people stamped as a very low probability coming out of the weekend, that is coming to fruition, and I think you're seeing a lot of hedge fund capitulation right now. Bullish trend. I do think the market's running a little bit hot right now. I do have an overbought signal on a few different metrics. We do have implied volatility signaling extreme complacency in those markets right now. So if we do see some back and fill, I do expect that dip to likely be bought in the S&P 500. So running a little bit hot, but clearly bullish trend, positive momentum. We're going to flip over to the gold market, clearly inversely correlated to the S&P 500 and movements in stocks, where gold was largely the safe haven instrument that a lot of traders flock to. We are starting to see some modest liquidation in that market. As you take a look at that chart, we do see the Twin Peaks up there. We saw the blow off top to 3,500, the retest to 3,400, and now we are breaking back down through 3,200. That is a key support area that we're breaking here today. I do have it drawn on the chart where I do think gold could perhaps pick its head up from some immediate term oversold levels currently, retrace, and then potentially see another breakdown back along that key psychological level of 3,000. Of course, there is a big shelf down there at 3,000 that's going to provide a lot of support. Our longer-term thesis in gold still largely remains intact. The fiscal issues here in the United States as well as around the world still remain at nightmarish levels, if you ask me. So the longer-term thesis still remains intact. However, I do think we are seeing a little bit of a pause in that uptrend from here. So trend still largely remains bullish trend. It's going to take a long way down for that to break. If we do see a break back under 3,000, that is going to tip that trend to a more neutral to possibly negative outlook. But still longer term thesis remains intact, but near term we are seeing liquidation in the gold market. We're going to switch over to the industrial metals now. We're going to take a look at silver and copper. When we look at a chart of silver there, I see a massive diamond formation in silver. What that is telling me is that there is going to be a massive breakout or possible breakdown in the silver market coming fairly soon. I think in potentially in a couple weeks, to be honest with you. Diamond formation, we're on about a 23-day compressed range between about 33.50 and 32 in the silver market. So once we break above that 33.50 area, I think that will be a confirmed breakout over the near to intermediate term for silver. Next upside targets would naturally be 35, which were the peaks just prior to the tariff announcements back on April 2nd. But a lot of compression building in silver. Same thing in copper. We flip over to copper. You're seeing a compressed range right now, a diamond formation. A big break is likely to happen in copper in coming weeks as well. So when I think about silver and copper, I think about energy. I don't just see metal. I see energy of the future. Of course, we are staring at some multi-year supply side deficit, specifically in silver, platinum. There is a supply side deficit forecasted for 2025 in copper as well. Of course, those play instrumental roles in the development of green energy, AI infrastructure, chip building, the whole nine yards. So still largely positive on the industrial space from here. Lastly, we are going to conclude with crude oil. Crude oil, as I mentioned earlier in the podcast here, we are down 18% year over year, down 11% year to date. If you take a look at crude oil, I do see a double bottom on that chart. We did see, I believe it was coming out of last weekend into Monday, we did see the announcement of further increases in production by OPEC. That shot the market down to 55, retested the old April lows, and we have seen price start to build higher from there. We are coming into a resistance area. The 64 area is a pretty strong resistance area. However, after perhaps another modest pullback to 60, maybe 59, I do think we will see a resumption of the uptrend, the near-term uptrend that we're seeing right now, and that would be a confirmed breakout. If we were to puncture 65, I think we can make our way up into 69 and 70 and fill that gap up there in the chart. We did just recently hear from the Republicans are talking about announcing a bill for an SPR refill. I believe that bill is going to cost roughly about $1.3 billion. So there is some positive news out there. If the United States evades a recession as well, I think demand is going to stay. I think it's going to stay there for the crude oil market. So I do think we can see a modest rise in the price of crude going forward. So that is going to conclude our inaugural podcast. Once again, I am John Caruso. If you want more of these market insights, I dig even deeper on a daily basis. I write a market insight note that we send out to our clients on a daily basis. Feel free to ping me at jcaruso@rjofutures.com. I can add you to that list, free of charge, 30-day trial, and we'll start sending you those reports. So best of luck to everybody out there. Thank you for joining me in the RJO Futures inaugural podcast of Rolling Trades. Best of luck.